To be clear, the future potential of this economy and its implications for jobs, real wages and wealth are not the gifts of monetary policymakers. We cannot immediately or fully offset the economic impacts of a large structural shock. However, monetary policy can support the necessary adjustments of the UK economy during a period of heightened uncertainty. And that's why, at its meeting yesterday, the MPC agreed an exceptional package of measures comprising, first, a 25 basis point reduction in bank rate to 0.25%, a new term funding scheme to reinforce the pass-through of that cut in bank rate to the borrowing rates actually faced by households and businesses.
It's trying to stimulate the banks to actually lend money in the real world.
With up to £10 billion of UK corporate bonds and a £60 billion expansion of gilt purchases. We took these steps because the economic outlook has changed markedly, with the largest revision to our GDP forecast since the MPC was formed almost 2 decades ago. Early indicators are consistent with the risks that the MPC had identified before the vote. And we now face a trade-off between the degree of support we give to the economy on the one hand and how fast we return inflation sustainably to target on the other. By acting early and comprehensively, the MPC can reduce uncertainty, bolster confidence, blunt the slowdown, and support the necessary adjustments in the UK economy. The degree and composition of that stimulus is largely determined by the effects of the vote to leave the EU on demand, supply, and the exchange rate. So beginning with demand, the 9% depreciation of sterling since the referendum will boost exports and weigh on imports. However, even though the MPC expects the current account deficit to halve over the next 3 years, improvements in the external sector are not expected to offset fully the drag from substantially weaker private domestic demand.
Saying the UK economy is going to decrease. That is the judgment of the Monetary Policy Committee, the MPC, and also because sterling, the pound, has fallen in value against other currencies. That is going to have an inflationary effect. And indeed, as this move was announced, the price of sterling, the value of sterling, the British pound, against other currencies did fall. These indicators have all fallen sharply, in most cases to levels last seen in the wake of the financial crisis, and in some cases to all-time lows. The MPC has been conservative in its interpretation of these data, producing a forecast stronger than historical relationships would have implied. Nonetheless, we expect aggregate demand to grow only a little over the next few quarters before picking up to rates below those projected in May. The extent to which this lower path for aggregate demand is likely to be accompanied by a lower path for aggregate supply is a key determinant of the inflation outlook. The weakness in demand will itself weigh on supply as a period of low investment restrains growth in the capital stock and productivity. There could also be more direct implications for supply from the decision to leave the EU. The UK's trading relationships are likely to change, but precisely how will be unclear for some time. If companies are uncertain about the future impact of this on their businesses, they could delay decisions about building capacity or entering new markets. In addition, in anticipation of the UK's new trading arrangements, a period of resource reallocation could be necessary as some sectors of the economy expand and others contract.